Welcome back to Nova Bourse. Today, we reach a critical milestone in our Fundamental Analysis series, Episode 10, the Cash Flow Statement. If you have ever wondered where the money actually goes within a business, this is the document that tells the story. While the income statement shows you what a company claims to earn, the cash flow statement shows you what is actually happening in the bank account. It is widely considered the most important document in fundamental analysis because it is the hardest to manipulate. Over the next 20 minutes, we are going to move beyond accounting theories and look at the real-world mechanics of cash, ensuring you never get fooled by a balance sheet again. To understand why this document is vital, look at the Enron paradox. In the fiscal year 2000, Enron reported $979 million in net income. However, its operating cash flow was actually negative $154 million. Despite this, the stock traded above $90 per share. Within 12 months, Enron filed for the largest corporate bankruptcy in United States history at that time. The cash flow statement would have exposed the truth that the income statement was actively hiding. In this episode, we will explain why cash flow is the ultimate truth teller, how to navigate its three core sections, and the specific red flags that reveal when a company is heading toward a cliff. Every cash flow statement produced under United States generally accepted accounting principles is organized into three distinct sections. First, operating activities show you the cash generated or consumed by the core business itself. Second, investing activities track long-term asset purchases and sales, which primarily consist of capital expenditures. Finally, financing activities capture how the company raises and returns capital through debt, equity, dividends, and share buybacks. The sum of all three sections equals the net change in cash for that period. Together, these three sections reveal where money originates, where it is deployed, and whether a company can sustain its operations without relying on outside help from banks or investors. When you open a financial report, you will notice that over 99% of United States public companies use what is called the indirect method for their operating section. This approach starts with the net income figure from the income statement and then adjusts it for non-cash items and changes in working capital to arrive at the actual cash generated. The formula is simple. Take net income, add back depreciation and amortization, add back stock-based compensation, and then add or subtract changes in working capital. Understanding this reconciliation is absolutely essential for any investor because it acts as the bridge between accrual accounting, where revenue is recorded when earned, and actual cash movement, which is when the money hits the bank. You might wonder why we add depreciation and amortization back to net income. The reason is that these are non-cash expenses. Imagine a company buys a machine for $1 million. They do not expense that full amount immediately on the income statement. Instead, they record a depreciation expense of $100,000 per year for 10 years. That expense reduces net income, but no cash actually leaves the business during those years. The cash left the business when the machine was bought, which is recorded in the investing section as a capital expenditure. Therefore, we add that $100,000 back to reverse the non-cash impact. For context, in fiscal year 2024, Apple added back approximately $2.8 billion in depreciation and amortization. Working capital adjustments are how we convert accrual-based net income into cash reality. If accounts receivable increases, it means the company recorded revenue but has not collected the cash yet, so cash flow decreases. Conversely, an increase in inventory means cash was spent on goods that are not yet sold, reducing cash flow. However, if accounts payable increases, it means the company received goods but has not paid its suppliers yet, which increases cash flow. In fiscal year 2024, Apple saw changes in working capital contribute a positive $3.7 billion to its operating cash flow. This was driven by a $6 billion increase in accounts payable, which was partially offset by a $5 billion increase in receivables. The investing section tracks cash spent on long-term assets and cash received from selling them. The most important figure here is capital expenditures, often called CapEx. This represents the cash spent on property, plant, equipment, and internal use software. Essentially, these are investments in the future productive capacity of the firm. Unlike operating expenses, which are deducted from revenue immediately, CapEx is capitalized on the balance sheet and then depreciated over time. A company with consistently high CapEx relative to its operating cash flow may be investing heavily for future growth, but keep in mind that this leaves less cash available for dividends, debt repayment, or share buybacks. Capital intensity varies dramatically by industry, so you must always benchmark against sector peers. According to data from the Stern School of Business, the auto and truck industry spends 149% of its depreciation expense on CapEx, meaning it is constantly reinvesting more than it is depreciating. The semiconductor industry spends 127% of its depreciation. By contrast, software and service businesses typically have ratios below 100% because their primary assets are intellectual property and human capital, not physical infrastructure. A retail giant like Walmart spends heavily on distribution centers, whereas a bank spends almost nothing on CapEx. Comparing these figures without understanding the specific industry context is effectively meaningless. Tesla provides a perfect example of how aggressive infrastructure expansion impacts cash flow. In fiscal year 2024, Tesla spent $11.3 billion on CapEx, up from approximately $7.5 billion in 2022. This capital went toward new vehicle manufacturing capacity, AI training compute infrastructure, and energy storage production, including the megafactory in Shanghai. Because of this, their operating cash flow of $14.9 billion minus the $11.3 billion in CapEx left only $3.6 billion in free cash flow for the year, down from $8.5 billion in 2022. By 2025, as CapEx moderated and operations improved, their free cash flow rebounded to $6.2 billion. The financing section answers three critical questions. Is the company borrowing more or paying down debt? Is it issuing new shares or buying back existing ones? And is it paying dividends? Cash inflows here come from issuing debt or equity, while outflows go toward debt repayment, dividend distributions, and share repurchases. A healthy, mature company typically shows negative financing cash flow because it is returning more cash to shareholders than it is raising from lenders. Conversely, a young growth company often shows positive financing cash flow as it raises capital to fund its expansion. Watching how this section evolves over time is the best way to determine if a company is in a growth phase or a mature, cash-returning phase. Apple's financing activities demonstrate what a mature, cash-rich company looks like. In fiscal year 2024, Apple announced a $110 billion share buyback authorization, the largest in United States corporate history. In fact, the 6 largest buyback announcements ever all belong to Apple. In just the first quarter of fiscal 2024, they spent $20 billion repurchasing stock and paid $3.8 billion in dividends. Under Tim Cook, the company has pursued a goal of becoming net cash neutral, meaning their cash on hand roughly equals their total debt. This strategy has significantly reduced their total share count and boosted earnings per share, showing investors that Apple has more cash than it can productively reinvest. Free cash flow is the most important number in the cash flow statement. It is calculated as operating cash flow minus capital expenditures. This figure represents the cash a company generates after spending the money required to maintain or expand its asset base. This is the free money available for debt repayment, dividends, buybacks, or building reserves. It tells you if the core business is truly self-sustaining. A company can have positive net income but negative free cash flow if it is investing heavily. Conversely, a company might report negative net income but show positive free cash flow if its depreciation charges are significantly higher than its actual cash costs. Always focus on this number to judge true performance. To see the power of free cash flow, look at Apple. In fiscal year 2024, they generated $118.3 billion in operating cash flow. After subtracting $9.4 billion in capital expenditures, their free cash flow totaled $108.8 billion. This represents a free cash flow margin of approximately 26% on total revenue of $416 billion. Over the past 5 years, Apple has averaged over $90 billion in free cash flow annually. This extraordinary consistency is what allows them to fund massive dividends and the largest buyback program in history while still accumulating cash. Their business model converts revenue into cash at a rate rarely seen in corporate history. Ford provides a contrasting case, demonstrating how free cash flow can be squeezed. In 2024, Ford generated $15.4 billion in operating cash flow and spent $8.6 billion on CapEx, leaving $6.7 billion in adjusted free cash flow. However, their 2025 guidance projects that number will drop to between $3.5 and $4.5 billion, a decline of roughly 40%. The company cited lower expected earnings, $800 million in pension obligations, and working capital pressures. Despite this, they still distributed $3.5 billion to shareholders in 2024. This gap between performance and guidance shows how quickly free cash flow can deteriorate when operating conditions shift, while fixed obligations remain. Returning to the Enron case, the cash flow statement was the only place where the cracks were visible. In the year 2000, while net income was rising, operating cash flow was negative $154 million. At the same time, their gross margins had collapsed from 13.2% in 1996 to just 4.6% in 2000. Meanwhile, non-current assets ballooned from 45% to 81% of total assets. Enron used over 3,000 special-purpose entities to hide debt, such as the Chuco entity, which concealed over $600 million. The cash flow statement was the only document that truly revealed the massive divergence between their reported accounting profits and their actual economic reality. General Electric's 2018 dividend cut is another example of a cash flow crisis. In October of that year, GE slashed its quarterly dividend from 12 cents to 1 cent per share to save $3.9 billion annually. The reason was simple. GE Industrial free cash flow was negative $4.8 billion for the year. Their cash from operating activities had collapsed from $11 billion in 2017 to just $2.3 billion in 2018. Compounding this, pension plan contributions rose to $6 billion, and GE Capital stopped paying dividends to the parent company. This serves as a stark reminder of how negative free cash flow forces management to make painful capital allocation decisions that directly impact the shareholders. WorldCom committed one of the largest frauds in history by manipulating the investing section. An internal auditor named Gene Morse discovered a $500 million computer expense that had been fraudulently logged as a capital expenditure. Further investigation revealed $2 billion in unauthorized CapEx from the prior year. By reclassifying operating expenses as capital expenditures, they inflated profits by $3.8 billion over 5 quarters. The scheme worked because CapEx is not deducted from net income immediately. It is capitalized and depreciated over time. A proper analysis of the cash flow statement would have shown that their CapEx was growing at an impossible rate compared to any realistic infrastructure expansion, exposing the fraud. When you're analyzing a company, watch for this red flag: operating cash flow that consistently trails net income. The cash conversion ratio, which is operating cash flow divided by net income, should generally stay above 1 for a healthy company. If the ratio stays below 1 for multiple periods, it suggests the company is recording revenue it hasn't collected, deferring expenses, or building up inventory it cannot sell. In Enron's case, this ratio was deeply negative even as profits were rising. For a mature company like Apple, the ratio typically exceeds 1 because depreciation add-backs and working capital management boost cash flow. Always compare these two numbers across at least 3 years to spot any deteriorating trends. Another major red flag is when capital expenditures grow substantially faster than revenue for several years. In the case of WorldCom, their CapEx surged while revenue growth stagnated, which was a clear warning sign. A healthy company's CapEx should track revenue growth or replace depreciated assets at a steady, predictable rate. Tesla's CapEx grew aggressively between 2022 and 2024, but this was justified by record vehicle deliveries and energy deployments. The key question is whether the investment actually produces proportional growth. If CapEx doubles but revenue only rises 10%, the return on invested capital is likely declining, and the company may be destroying shareholder value. Be extremely wary of a company that consistently generates negative operating cash flow, but shows positive financing cash flow. This means the company is borrowing money or issuing stock just to pay its daily bills. While this is normal for a young startup in a pre-revenue phase, it is a sign of potential insolvency for a mature company. GE in 2018 is a classic example. They relied on intercompany loans and debt issuances to fund operations and maintain their dividend while their industrial business was burning cash. When a company must rely on financing inflows just to cover operating outflows, the business model is fundamentally broken, not just facing a temporary cycle. To wrap things up, use this 5-step checklist for every cash flow statement you analyze. First, confirm that operating cash flow is positive and trending upward over 3 to 5 years. Second, verify that operating cash flow exceeds net income, which indicates high earnings quality. Third, examine CapEx relative to depreciation. It should roughly match unless the company is in a massive growth phase. Fourth, check the financing section to ensure mature companies are returning cash to shareholders rather than constantly borrowing. Finally, calculate free cash flow and track its trajectory. Free cash flow is the ultimate measure of a company's ability to create value. If you follow these 5 steps, you will be ahead of most retail investors. Let's summarize the 5 principles of this episode. First, the cash flow statement is harder to manipulate than the income statement because cash is an objective fact. Second, free cash flow determines a company's ability to survive and reward shareholders, not net income. Third, always read all 3 sections together. A company might have strong operating cash flow but mask serious problems by borrowing excessively in the financing section. Fourth, compare metrics across time rather than looking at a single snapshot, as trends reveal the true health of the business. Fifth, remember that industry context is everything. Never compare the capital intensity of a semiconductor firm to a software company, as their financial profiles are fundamentally different. Now that you can read a cash flow statement, the next question is how to use those numbers to determine whether a stock is expensive or cheap. In our next episode, episode 11, we will cover the essential valuation ratios: price to earnings, the PEG ratio, EV to EBITDA, price to book, and free cash flow yield. We are going to apply each of these ratios to real United States companies to show you how to determine when a stock is truly undervalued versus when it is just cheap for a very good reason. I look forward to seeing you there as we turn these financial insights into a practical valuation framework.